All right, so let's get into what is recommended for a company to put in place if they want to have a strong internal control environment. So these are the guidelines straight from your book. So a strong internal control system is going to have the following elements. And obviously this list is not comprehensive. They can have a lot more items. Other books that you pick up might have additional items, but it's definitely a good start, right? Okay, so first we want to make sure that there are clear responsibilities laid out. A good example of this, well, let me just say why it is. So individuals are more likely to behave ethically if they know they'll be held accountable. More behave ethically if they know they will be held accountable. And I think a good example of this is if you've ever worked in retail and you've had to have a cash drawer, when you come onto your shift, you usually go up and see the shift manager and they assign you a cash drawer and you are responsible for, counting it, making sure it has the balance it's supposed to, and at the beginning of your shift, at the end of your shift as well. So they don't just have, one cash drawer and when you come on your shift, you just take over that cash register. You get assigned your own cash drawer to put into the cash register you're assigned to, right? Because if there's large amounts of cash missing on a consistent basis, you're the only one that has access to it during your shift. So they're going to be able to trace that back to you, as opposed to a cash register, where there are lots of employees using it. Well, then they can point the finger and say, oh no, the cash was fine. I was giving out accurate change when I was using it. It must have been so-and-so. Oh no, it must have been so-and-so. And they can just point the fingers at each other and the company really doesn't know, right? But usually you just have one individual assigned to that cash register. They're more likely to behave ethically. Proper documentation, right? In accounting, we use what are called source documents. So some sort of original document, usually coming from outside of the company, starts the chain for, a cash distribution, for example. So for example, we receive an invoice from a supplier. That invoice has an amount that we have to pay. That then triggers the check writing process internally. Okay, but usually don't just start writing checks unless you have that source document. Okay. So having documentation, carrying adequate insurance, right? You can insure your employees. That's called bonding, right? So if you have employees, usually you would just do this for the top, officials in the company, like the controller or the CFO, things like that. So you can insure employees, you can insure your inventory, right? In case there's some sort of natural disaster or theft. You can obviously insure your building, so you can insure all your company assets. And it's just a good idea. That way the company is protected against any type of loss, be it fraud or some sort of disaster. Separate your assets from the custody of those assets. This is probably one of the more important elements of internal control. When fraud happens, it's usually because there's no separation of the asset custody from the asset record keeping. Okay, so for example, you don't want the same person who writes the check also to be able to sign the check. You want to separate it out. You want to have one person write it, make out who that check is going to. It should be based upon a source document, right? So if they make out a check for $400, you can trace that back to the source document. Then a different individual signs the check. He will sign the check. And that person, once they sign it, they'll be looking to make sure the source document is attached, it's for the same amount, etc. So you want to separate that. You don't want to have the same individual write the check and then sign it. You want to have that separation of duties. Oh, actually, I think I'm skipping ahead to this one, separation of duties. Separation of duties. Let me go back to assets from custody. For this one, I'll give you the example that we saw at our company. We had an AR clerk. Okay, she received sometimes it was cash or sometimes it was checks. So AR receives all the customer payments, right? So then she received the assets. So she had custody of the assets. Okay, you want to then separate the record keeping. So someone else should do the record keeping of those assets. And here's why. So we had AR clerk receiving cash payments. Okay. Then that same AR clerk did the journal entries, the posting to the customer accounts. So she would pull up Mr. Smith's account. Mr. Smith owed, let's say, $100. Mr. Smith paid $100. So the correct journal entry would be, cash and AR to decrease Mr. Smith's account. She didn't do that. She kept Mr. Smith's $100 cash. Okay, so now Mr. Smith still has a balance of 100. Then when the next client paid, maybe this was Mr. Adams. Adams owed $150. So if you pull up his account, Adams, 150. So what she would do is she now has the $100 from Mr. Smith. She would take $50 now from this Adams check and apply the $100 from Mr. Adams to Mr. Smith's account to show it paid off. Okay, so now she's got some money. Mr. Smith's account shows that he finally paid it off, but Mr. Adams doesn't. Then when the next customer payment comes in, she would do the same thing, little off the top for her, and then apply that new customer's payment to the old customer. This form of fraud is called lapping. And she was able to do it because she was collecting the cash and recording where it went. Okay. So if you have two individuals, one that opens up the checks and receives the cash and then makes a record of it, right? Mr. Smith's payment came in for 100. They send theirs to general accounting, right? They send the checks to AR. So now there's a separate document that goes to general accounting. And if general accounting doesn't see that journal entry coming in for Mr. Smith, there's at least some sort of oversight, right? And ideally, she wouldn't do the journal entry, or like I said, probably the cash would go to like a treasurer. You want to separate the asset from the person recording it because they can just cover up the fraud. And other popular examples with inventory, you want to have a separate person ordering the inventory, ordering all the boxes of inventory, and have someone else receiving it. So that they can verify we ordered 2 boxes of, Pokemon cards. We received 2 boxes, right? Because if you had the same person ordering it as receiving it, they could say, oh, I ordered 3, I only got 2. But really that third one, they kept for themselves, right? So they could just cover it up. Very long explanations. Sorry about that. And then finally, use technology. There's so much technology available. Use it. Right? We can use passwords to protect access to different company information. We can use, computer programs. We can use security systems, right? We can use surveillance systems. We can use asset tags, right? When you go into a store, you try something on it, it has that annoying little tag on it. Right, that's to monitor the asset and make sure that it doesn't leave until it's been properly removed, meaning it's been paid for. Okay, you can read through some additional examples in your textbook for internal controls, but there are the elements that a good and strong internal control system would have. May not have all of them, especially if it's a small business, they may not be able to do the separation of duties. Right? We understand that they may not be able to buy all the latest technology, but if they can just implement some of these, it could go a long way to preventing fraud at their company.